and thank everyone for being here. Can you all hear me okay? Is this good? Okay, great. Well, the men here almost need no introduction. I was just calling them the backbone of the industry, really important figures. We're here today talking about cannabis REITs. REITs, of course, stands for Real Estate Investment Trusts. I'm going to let each gentleman introduce himself and tell you a little bit about the REIT that they work for and what kind of a REIT it is. Go ahead, Travis.
Sure. So my name is Travis Goad. I'm a managing partner at Pelorus Equity Group, and we are a mortgage REIT. So we actually lend money rather than do a sale leaseback or purchase your asset. We're the longest running cannabis-specific real estate lender in the country. We closed our first cannabis loan in 2016. We've done about $460 million in origination since inception. Today we have about $320 million in AUM. We were the first cannabis debt fund to ever get an FDIC insured line of credit. We were the first cannabis debt fund to ever issue a senior unsecured bond, raised $50 million last year that way. And we're an open-ended fund, so we let money in continuously, and we've been raising about $10 million a month on average.
Hi, Don Brain, Chief Executive Officer of Freehold Properties. We were originally organized as an equity REIT. We have restructured in order to qualify for a NASDAQ listing as a mortgage REIT. I think the unusual structural change for us, though, was also that we retained a purchase option on the real estate upon legalization of cannabis. So we hope to bring to our shareholders the opportunity to participate in the upside value of real estate post-legalization. So we're like a number of companies waiting in the queue for a steady market for an IPO on NASDAQ.
Well, good morning. Anthony Coniglio, CEO of Newlake Capital Partners. We own 31 properties across 12 states with 12 separate tenants. We're a public company. Ticker is NLCP. We've been in business since early 2019. Thrilled to be here.
Steve Miller, Chief Investment Officer for Viridescent Realty Trust. We are a mortgage REIT as well, as two of my other colleagues here. And we have only been in business, we're the youngest to the market, which comes with its advantages and disadvantages given the cycles that we've all seen over the last several years, having really been formed in August of 21. And continue to lend to the industry, continue to raise money to continue increase our assets under management. We are currently private and enjoying the lack of drama at the moment for being a private company, but also through the advantages of our public brethren. So we're very open to all kinds of structure and organization.
Excellent. So I think a lot of the big investors, a lot of the big players in this space right now are REITs. Why do you think that is? Like, why is the REIT structure so useful in cannabis?
I could touch on that. I think because cannabis itself is a very capital-intensive asset. To grow quality cannabis, you have to build a greenhouse or indoor facility, and that costs a lot of money. And so for most of these companies in an early-stage industry, real estate is your number one asset on your balance sheet, and it's something that you want to hold on to and continue to own. So these REIT structures allow us to pool capital from investors, and specifically for us in a mortgage REIT, make a first lien senior secured loan to help fund the growth of the industry.
I think almost every mature industry in America has discovered that owning real estate is an inefficient use of capital. So you see REITs targeted to every business across every business sector. And I think particularly in the cannabis space, even though it's a young industry, REITs make a lot of sense in the capital markets because there's no leverage available, traditional leverage, for an operator, and so it's a way for them to not dilute their equity capital and continue to grow their business.
Related to that, for people who are maybe used to REITs in other industries, also what are some of the unique challenges doing this in cannabis? Besides, I'm sure illegality is a big one, right? But yeah, besides that.
Raising capital, it's really hard. It's really hard for the operators. It's really hard for all of us. Also, something as simple and mundane as getting title insurance. Whenever you close on these properties, there are very few people that will settle on title insurance. So like everything else in cannabis, it's just as difficult on the real estate side. And also when you look at the specialized nature of these properties, think about other property sectors such as data centers or lab space, where these properties, particularly on the cultivation side, are specialty built and require different levels of power and water. It requires a different knowledge set to be able to underwrite that transaction and understand the real value of the transaction, when you could be into the property for 3 times what an alternative use may be.
Yeah, I think to expand on that and agree with everything Anthony said, in addition, I think valuation is always the yin and the yang between the borrower, the lender, or whether it be the purchaser for a property REIT. And I think that always presents a very unique challenge. And then too, the level of exposure and risk, given those valuations, that you're willing to extend. If you don't mind going back to the original question, the other reason when you say why are REITs so common, while capital is very, very dear, and agree with Anthony as well, I think that we have been one of the places that have capital. And as a result, in an industry that is starved for capital, we have it. And while we measure it out pretty judiciously, it is available, and it is available to strong operators with the right set of assets and properties.
You mentioned...
I'm just going to jump in on that. So if we were to dial back to conferences 18, 24 months ago, there was always the question, what does safe banking do? And we always answered it that safe banking, we think that as a group we would benefit first from the banks focusing on the industry, because banks want to lend money to a professionally managed, diversified portfolio of commercial real estate before they'd spend a lot of their capital focusing on the sector. And I think that's what you're seeing. I think Travis talked earlier about the debt that they've taken on. We've raised $90 million of additional credit capacity from banks. And while there's some of that happening at the operator level, the banks and some of the large institutional investors like the professional approach that we bring to managing a portfolio of diversified properties.
Yeah, I would touch on that because we face the same challenges as cannabis companies generally in accessing debt markets and other things that most traditional REITs, not in the cannabis space, are funded with a mix of equity and debt. And so debt has largely been, until recently, unavailable. So we were one of the first to issue the bond. There's some banks out there starting to provide lines. But to Anthony's point, we think in a safe banking world, we can access capital markets more efficiently like we're supposed to be able to as a REIT, and be able to continue to compete and pass those savings and capital on to our sponsors.
Wouldn't that be crazy to just be like a regular business?
Yeah, right.
Well, Steve touched on valuations. I think this is an interesting place where there might be some differences of opinions here, different ways that different REITs are valuing these companies in order to loan to them. Can each of you maybe speak a little bit about how your REIT looks at it?
Yeah, so we view the entire sector as kind of a hybrid between real estate and corporate lending, because you have to have the license to be able to have a functioning facility. A lot of these specialized build-outs, HVAC, lighting, you don't need that to grow tomatoes. So it's important that you're collateralized by the OpCo and the PropCo. And so if you think about it kind of like on a political spectrum where there's a pure corporate lending model over here and a pure real estate lending model over here, we're about as close as you can get to a pure real estate model. I mean, we are still secured by the OpCo and PropCo, but we lend against the cost that you spent on the facility, so hard and soft cost on the asset. So we really take a cost approach because there's not a lot of trade comps in this market. There's not a lot of secondary transactions. And so we look at replacement cost as a pretty good indicator of value, and we'll lend against that. So our model is different. There are other mortgage REITs out there that really function more as a BDC, and they'll actually lend you maybe 180% of the real estate value, but they'll wrap you up with a lot of corporate covenants, and they'll want control, they'll want board seats, et cetera. We lend you lower proceeds than that, but we lend you against the value of the real estate, and we have a very covenant-light model. So we think it gives sponsors the most flexibility to be able to lower their cost of capital over time and grow their business.
Yeah, I think, just to pick up on Travis's point, I think that as we look at the credit landscape, one of the challenges is that there are so many operators in this space, and with additional licenses being released in so many states, that continues to be the case. And one of the things I think we all see is a lot of pro forma projections, for the business, especially as markets expand from medical to adult use and into new states. I think that the challenge is that no REIT wants to be an operator. We want to simply be a rent mortgage payment collector for the shareholders. And I think the challenge is to make sure that we find, we work to find, good credit-worthy operators who, have access to capital, strong management teams, and financial performance to have rent coverage or mortgage coverage. Sorry.
If I may, and going back, there are a lot of different REITs and different styles, and I think great points made by my colleagues up here. One, I know for our part, we do try and be very much true to the real estate in the context of the operations. We do not try and conflate enterprise values with actual real estate values in terms of coming up with that. And that's often, again, going back to that yin and yang evaluation, is my property worth so much, look how much income it generates. And sometimes, whereas in other businesses that's a direct correlation, it isn't necessarily in cannabis just because of, again, the specialized use that it has. The other part of that is, and I also agree that operating a business is not what we're in the business of doing other than making mortgage loans into the cannabis space. But one of the things that we do have is we have a lot of operational cannabis experience. That would be an interesting one. Cannabis experience locked in our organization. And I can't think of any operator out there that hasn't stumbled once, twice, or three times. And large, small, multi-state, single store. And we feel one of the things that we can bring, and I'm sure others can bring as well, is that operational experience to help our borrowers overcome these stumbles, and with the understanding, having made most of the mistakes in the business ourselves at an operating level in different and past lives, that it brings a certain understanding with how to deal with those problems and how to work with our borrowers to resolve those.
Yeah, so we're a little bit different than the lenders because we're a sale-leaseback REIT, we're an equity REIT, so we acquire the properties from and for our tenants. We enter into 15 to 20-year leases. So when we're doing our underwriting, we're thinking about not the refinancing that may occur, we're thinking about will this business and will this property generate sufficient cash flow to cover rent, and can this management team manage a business for the long term to cover rent for the full term of the facility. And so we're looking at property level cash flow. We're requiring reporting on a quarterly basis to understand what the property is generating and what we call EBITDA coverage. That's EBITDA plus rent. I know this industry focuses on EBITDA, adjusted EBITDA, or whatever metric makes them look good, but we look at real cash flow. What is the property generating in cash flow? We also focus on limited license states. We believe that focusing on properties in states where the license is typically in some ways connected with the property itself creates incremental value for us. But we also, to Steve's point, we know that nobody's going to pick 100%. You're not going to bat 100% or bat 1,000 in this industry. You will have tenants that will have some difficulties, but in the limited license states, there's intrinsic value for that license. So if the business is suffering, someone will likely step in and acquire that license because there's real value there, thus minimizing the adverse impact to our overall cash flow. So for us, it's focusing on the long term. It's modeling haircuts on margins. It's modeling production and pricing because we know that's going to happen during the duration of our tenancy.
Excellent. I think we've heard a lot in this conference about the investor who's kind of just waiting for legalization as a payout. Do you think that's a good idea for a REIT investor? Is it all about getting to that legalization point, or how is it that you succeed?
So our investors are not having to wait for legalization for a payout. We've returned 15% every year since we've been in full operation. We do monthly distributions for cash flow, so our cash distributions are in the 12 to 13% a month range. Most of our investors, about 40% of them, just reinvest. So our investors don't have to wait. We think that our business model is set up to thrive in this environment, which we are doing, and continue to thrive upon legalization to where we can access capital markets better. We're actually one of the few groups that are still raising capital today. We're in the process of closing several transactions as we speak. So I think it's important for borrowers to always ask. I would ask, any lender or person you're talking to, how many transactions have you closed in the last 3 to 6 months? Because there's a lot of people that used to have capital that don't really have capital anymore, and we're still very active. We're bullish long-term on the market and looking to deploy capital.
I think the REIT sector in cannabis is probably the safest investment for an investor who is either unsure about how deeply they want to get into the operating business in cannabis or prevented from doing that. I think if you look at the REIT valuations and the returns to shareholders from dividends and the intrinsic value of mortgages and or real estate holdings, it's been a win for the investors. I think it is. I think it will continue to be a safe harbor, going forward. I think all of the talk about legalization has ultimately, in some respects, done the industry harm. Because I feel like if you're outside the industry, if you're an institutional investor who doesn't really know the industry, hasn't studied it in depth, I think it's easy to hear the talk and feel like, okay, there's just one disappointment after another, in terms of legalization. So I think the industry needs to focus on operating in the environment it is today, and I think, everybody on this panel is, doing underwriting on the basis of not necessarily safe banking or legalization.
Yeah, I pick up on Don's point. I think that this industry, I like to say that this industry is probably the most optimistic set of entrepreneurs I've ever come across. And everybody thinks that safe banking is going to happen or legalization is going to happen. And that excitement feeds into the investment cycle. And now we've seen a couple of times wherein some investors have bought into that and they've been burned. And so now we're in this relative value debate in the investor community, which is, I've been burned before here, maybe there's a better relative value opportunity for me away from cannabis, look at everything going on in markets, let me deploy my capital there. If I want to raise another fund or I want to raise additional capital, I have to show some returns to my investors. So let me go make my returns over there, and when I believe we're getting closer to legalization, which is the real catalyst for value in this sector, I'll rotate back into cannabis. So I'm not going to miss the trade. I'm going to be able to get back in before most of the value is baked into the prices. And how does that impact us? I think when I talk to some of our large investors, they sit there and they say, I still have the upside opportunity, but I'm getting paid. To Travis's point, I'm getting paid 9% yield, which is what our yield would be right now if you bought it. I'm getting paid 9% cash money to wait for that return. Where can I go get that and be collateralized by a diversified pool of commercial real estate? So I think the REITs somewhat benefit from that alternative trade for us within the cannabis sector.
I think what, again, my colleagues have said without using the words is, we are the single most boring investment you can make in the cannabis space. We are steady, we are consistent, we're not subject to boom and bust cycles either through the business cycle or through the financial cycles. And our job is just to print a nice dividend that tends to be superior because of the risk profile of the business itself, of other REIT-like or dividend or interest-bearing companies, while at the same time preserving capital. And again, when I say it, it seems so simplistic. It's not as simple to achieve that. We all work incredibly hard to be able to make that work, but it is supposed to be a very boring, kind of low drama, low volatility business. And I think I'm hearing absolute agreement in that. I just kind of want to put it to words.
Yeah, it's nice. It seems like you all are friends, right? You're all
Yep.
friendly.
All very
Everyone's
friendly.
success is the industry's success, so that's great. How about the next 1 to 2 years? I feel like I'm hearing a lot of whisperings. It's just going to be a hard time for cannabis companies. How are you guys preparing for that, or do you feel, since you all have mentioned how safe this investment could be, that you guys are pretty protected even if that happens?
Yeah, so under our model, we're lending against a hard asset valuation rather than the BDC model, which is more of an enterprise value or license value, which we think licenses, even limited license states, will be forced to issue new licenses over time. So we're watching the industry, we're talking to our borrowers, we're talking to new people. Everybody is, there's a lot of struggle out in the space. I mean, everybody's sales are down from last year to this year. And generally it's, given 280E and some of the other negative impacts, the companies are feeling it. Now, we're talking to our sponsors. Our portfolio is still performing fantastic, but we are getting quarterly financials. We're updating it. We're having conversations with sponsors. What's going on? Tell us. And we're baking that into our underwriting as we go to look at deploying new capital. So we still are lending in the space. We'll still go to any legal market. But what we're able to do, one, pricing has changed just as risk has repriced across the capital markets broadly, even away from cannabis. But also, since we are still deploying capital, we're able to go in an up in quality bias with sponsorships and really still, create those relationships.
In spite of the comment earlier about the industry not focused on safe banking and legalization, I do actually think that safe banking will get approved over some period of time in the next 2 years. I think I was listening this morning to Boris from Curaleaf talk about the consolidation that he expects in the industry. I do think there's going to be a lot of consolidation because I think there are a lot of operators who have either a single property or a license or a something, and I think they're not able to raise capital. I expect more bank debt to come into this industry. That won't make the rates from the four of us and others cheaper because interest rates are rising. Having said that, I think it will provide liquidity to the industry that it's very difficult to raise private capital in this, going forward. So I think that the combination, there'll be more better run and larger operators in this space. I think there will be more bank debt available to moderate some of the rate increases, and I think with this industry will provide the REIT industry will provide capital to the cannabis growth, to fuel cannabis growth. So.
Yeah, listen, the tone in this conference has been fairly negative. It started back in April. For those of you that were in Miami, it was fairly negative now. I've said the difference between the two is that, to me, in April, people were feeling a little bit more shell-shocked. I think now people are a little bit more resigned to this is where we are. I think over the next 2 years, not to repeat what was said, so I won't, we're going to see negativity. Within our portfolio, though, we've been fairly lucky. We haven't had any defaults or deferrals of rent since the inception. Everything's been paid on time as originally contracted, but that won't last forever. We will have issues, but again, if you're doing good underwriting, and we always underwrite, we're always haircutting the margins that people tell us they will have. We're always haircutting top line revenue because we know prices will come down. Again, underwriting for the long term. And if you're in a limited license state, again, our focus, we think we're going to be able to protect most of our NPV or most of our cash flows because we think we've done a good job of selecting the properties that people will want to be in. And so we think these licenses will be coveted. We think these licenses will find a home if they have to find a home in the first place. And so it'll be a dark, one of our directors said we're in a nuclear winter. He said it at our May board meeting, and I believe that. And like in any credit business, and a lot of what we do, or almost entirely what we do, is yes, we look at properties, but also is the credit. Because you can get a high cap rate, but if you can't collect on it, well, you don't have good return.
Right, exactly. Well, it's been a while since I heard the question. But if I heard it originally, it was about what do we think about the next couple of years going forward. And one, I've never had a very good crystal ball. And actually, even if you ask me to predict, flipping a coin, if it should be 1 out of 2, I'm probably good for 1 out of 4. So, that being said, though, it is always a case of, look, hope for the best, prepare for the worst. And by prepared, that doesn't mean, being draconian or being overly conservative. But again, it comes back to issues of valuation, testing in down cycles, seeing how well these companies can survive, knowing where they operate, knowing how they operate, knowing what the macro environment, or not so much macro, but the statewide environment, the local license environment is, and having the best sense of how your particular asset should perform through those cycles. And to the extent it doesn't perform as expected, and I think Anthony has been very forthright in saying If all of us 2 years from now can sit here and say we haven't had one hiccup in the portfolio, I'll be very surprised.
I would bet against it.
I would bet against it.
Exactly. So once again, I think you see terrific alignment amongst the group. So if you turn around, it's just being prepared. How are you prepared organizationally? How have you prepared yourself from the minute you entered into that loan in order to be able to resolve it and best protect your investors and their capital in your organization? So over the next 2 years, whether it's an up cycle, a down cycle, or a very quiet cycle, we see performing exactly the same way and being prepared for all of those outcomes.
Excellent. I think you guys anticipated my question and may not have much to say about this next one, but any war stories? Are you finding it very difficult when there is a default situation with all the intricacies of cannabis law?
I couldn't get into the party last night, and I was really upset. So.
I heard about that.
You guys, I'm done.
No war stories. I think we very much, I'm sure my colleagues do the same, we very much take a partnership approach with the tenants because we're together. Again, we're together for 15 to 20 years. And we dialogue with them on a very regular basis. We understand the dynamics that are going on in the industry. And we try to do everything we can to help them succeed. So whether that's making introductions for capital if they need capital. We've had situations where some of our tenants have sold and we've provided them insight on the M&A process, given some of our backgrounds. So it's a real partnership and there's a constant dialogue, but no war stories. Sorry to be boring.
Yeah, I would just add to what Anthony said. We are the biggest cheerleaders for our operators. We want them to be successful. And honestly, as much as we all would love to continue to be an extremely, and we will be, an extremely important capital source to help grow this industry, because it's, I think Travis said at the beginning, it's a very real estate-centric business. But we would love to see some improvements in the equity values so that operators can not just look for a single source for growth, but can sell equity too.
Which is the advantage, and when we talk to our sponsors, we take a very similar approach, is you want a cannabis-specific lender to be your lender, because there are going to be ups and downs in the cycle. There's, especially given the regulatory environment, 280E issues, all of these issues. Try explaining that if you were to find a one-off bank to do a loan. You want somebody that understands these issues and can kind of work on structure around things to meet your needs over the life of the loan.
What would be the single best thing for your partners right now? Would it be 280E going away? Would it be full descheduling?
So I think 280E is one of the biggest issues facing the industry. So we think for that to go away, though, there's going to have to be a federal excise tax, and how that looks. So they're so tax disadvantaged. No other industry has ever had to face that kind of at the start of a new basically entire new industry. And so we think that's a major headwind that we would like to see addressed. We definitely think that would help them to get to profitability and do it. And I think, I think that's probably one of the biggest things.
Yeah, I would say for our operator partners are not built for the hope of interstate commerce. They're successful in a state-by-state business. So I think ultimately for the clients we work with, it'd be probably lower cost of debt and capital, so that the more capital flowing into the equities of their companies, but also lowering their debt costs, because the debt costs in this industry are reflective of the infancy of this industry, the financial performance of this industry, but also the illegality.
280E hands down. It is a capital raise for the industry, for everybody in the industry, right? Talk about access to capital, to not have to pay that tax anymore is very valuable and puts cash directly on the balance sheet. And then it's all about cash flow. I was listening to Nick Vita here talk about it earlier. It's all about cash flow, right? Yes. This industry is no different than any other industry in the world. It's about cash flow, and it's about being able to pay your bills and about being able to invest in the future. And repeal of 280E would provide, I think, more capital and more fuel to the industry than decriminalization. While that'll bring in some new investment, that's a longer cycle, whereas 280E, I think, gives a bigger boost faster.
Yeah. net free cash flow through any means reasonably possible, and 280, of course, being the biggest one. Two, I think access to better value of equity capital, I think, as Don put out, because that strengthens the company, it strengthens the debt, it makes, and frankly, if we can be lower levered in these companies that allow us to, frankly, pass through savings through rate, I'm not suggesting, going down a, SOFR flat, but, stronger companies get better loans. And the third one, and being able to bring capital to some of the environments that are a little more capital starved, and I mean that some of the states. Because I think some of the state regulatory environments keep some of the lenders away from those states because of the market competitions, the unregulated market competitions that have created incredible price dislocations in those states, as well as states that have not adequately regulated the amount of production, which again has created a lot of turmoil for our borrowers and forces us as lenders, I think, to be even more diligent in terms of where we would allocate our capital.
Well, I think my ears perked up when Don mentioned interstate commerce, right? I think that's a big bear in the room. Also, you would imagine, of course, with interstate commerce, consolidation of these facilities, and you guys are a real estate heavy investment, obviously. So do you guys look ahead to that? I guess, is it really relevant to you yet? It's going to be so many years. I think we'll know in advance that interstate commerce is coming, right? You'll have some time. But how do you see interstate commerce really changing or affecting your portfolios?
Yeah.
If at all?
I'll go first. So for sure, 15 to 20 years. We don't think interstate commerce happens anytime soon. We think it's at least 7 to 10 years away, but as I said, our portfolio is 15 to 20 year leases. So within the life of these leases, we do think we'll see it. We think the states will fight tooth and nail to protect the jobs and the taxes and the ecosystem it's created, but ultimately I think the law is against them and they'll lose. When that does occur though, understand the backdrop. The backdrop is more around legalization, which ushers in this massive growth for the industry, which will require massive investment in infrastructure, which provides more opportunity for all of us. For our existing properties, I don't see our tenants, particularly for the properties we have, high quality indoor grow facilities, and knowing that roughly 50% of the product that's sold today is high quality flower, we don't see that customer demand going away for indoor grown flower. I think what you'll see is you'll see the uptake for new investment, maybe shifting to other locales. But I think the operators have people, they have capital invested in these facilities, even the ones that we own, in equipment, in training, in compliance. I don't think they're just going to shutter the locations they have all around the country and then move it somewhere else. So I feel good about the duration and the durability about the properties we've invested in, but then also we've invested in properties that are located where there is an alternative use. So if that's a wrong view and they do move out, we can pivot to other assets, to other uses.
And I think a bit in contrast, and not better nor worse, just different, our loans are typically 3 to 5 year loans. And so when you start talking about interstate commerce and its effect, anything can happen. Again, I did talk about my crystal ball earlier, but we think that we're pretty well insulated where we've made investments where any dislocations or any disruptions through interstate commerce would affect our borrowers. So anyway, it's just difference in philosophy, difference in approach, difference in portfolio risk, each with their own attendant risks, of course. The other side of that on the interstate side is it'll be very interesting. I mean, some of the states are going to be incredibly protective of their tax revenues, their employment revenues. So even if by the stroke of a pen at a federal level, interstate commerce is enacted, you still have 50 jurisdictions, 51 I guess if you count DC, and 52 if you count Puerto Rico, right, that are going to be making their own rules, defending their own turf, and figuring out what barriers and moats they're going to put around their revenues that frankly, as the states have grown, have become incredibly important to running those states.
I agree with those comments. I mean, I think we're longer-term financiers, as Anthony is. We don't think that interstate commerce is going to ultimately impact this cycle, shall we say. I do think that the state regulators that I've spoken with, particularly along the Eastern Seaboard, are, very protective of their jobs and the facilities that they've licensed, and I think it's going to be a major turn before the industry really sees the.
Well, these are multi-million-dollar facilities to build out. It takes
and the newer ones are extremely efficient in terms of their output quality.
Yeah, correct. It takes a while to build them, and it takes a while to get them dialed in as well. There's a lot of growers in this audience. When you have a new facility, oftentimes you have hiccups and issues, and sometimes it can take a year and a half, 2 years to get all the yields where you want them to be and producing consistent product that you want. And so I also agree with everybody on the stage said here, and we're shorter duration, so that's a hedge for our book. But two, you have to just walk away from all that capital investment. So we think we're pretty well positioned, and we think that in the interstate commerce world, you need the infrastructure that's already been constructed.
Yeah, I just add one other point on the properties that we own. I should have mentioned this. Inflation is actually our friend, because if you think about the replacement cost of some of the buildings that we have, maybe we're into that building for $300 a square foot. To build it today, let alone 7 to 10 years from now, is going to cost a lot more than $300 a square foot. And so while inflation has some negatives to it, it impacts positively a long duration portfolio like ours, as that replacement cost for the buildings that we own go up and make it even more expensive and more difficult for one of our tenants to opt out of our facility and to go and build a new facility somewhere else.
So REITs are very local, of course, right? We're all talking about the U.S. Do you guys do anything globally? Do you look at global cannabis? Does it have any impact on your lives? It looks like no.
So I'll take that. We think understanding the global markets are extremely important for this space, whether it be Canada or what's happening in Europe. And so we're studying all of those markets and looking to expand into markets outside the U.S. as we see appropriate. So we do have an eye on the international markets.
We also have looked, I think raising capital in a legal environment on a global basis could be easier. But there is so much opportunity and need in the United States that, and there are good operators and there are good properties to finance. So it's more, there's plenty of good opportunities. It's just about matching up capital.
Plenty of opportunities here. The vagaries of regulatory oversight for this industry are difficult enough to figure out what's going to happen in the U.S. and all the states, let alone trying to figure out what's going to happen in Germany and some of the other countries that are out there. And so where we think we're better served for us is to spend our time focused here and not try to figure out those other countries' constructs.
Yeah, what they said. Absolutely.
Right. Well, I wonder, I bet a lot of people here know about IIPR, which of course for many years was medical only. Are you all medical and adult use, or are you still bifurcating?
We're both. I mean,
Great.
you see most markets, it starts medical and then it goes into recreational. So the way we're structured is as a private mortgage REIT. The distinction between medical and recreational isn't as important as it is to a publicly listed company that has a different level of compliance. So, we're a lender to all.
Yeah, we are too. I think everybody in the industry is. I know IIPR is too. I feel like that was a bit of threading the needle for them with NYSE back in the day under the Cole memo. But there's very little distinguishment between medical and adult use in most states, except for maybe taxation of the purchase or something. So
Same.
Yes.
Excellent. Well, we're all in agreement. Does anybody have a wild prediction or final statement they'd like to make in the last few minutes we've got?
Are you going to the party tonight?
I think the wild
did anyone
prediction is
see,
I think we're all going to lunch together, because this is going so well so far.
No predictions.
Yeah, none on my end.
We appreciate you as moderator.
Yes.
Thank you guys very much. All right, I think we have a minute if anybody else wants to ask a question. I don't need to, spend all the airtime, or we can just say, oh, right here. The question was whether you invest in CBD and CBG, type facilities as well, or if you're all just in cannabis THC.
We've been strictly THC focused.
Same. THC focused. It's where the yield is. CBD companies tend to have more opportunities. Although, anybody that wants to talk about safe banking, creating competition, you had hemp legalized back in 2018. We still get calls from hemp operators because the banking regulations are still getting settled out for an industry that's been federally legal for 4 years now almost. So it's going to take time for regulators to sell out regulation.
Which might be an indication for the future if cannabis is in fact, THC is legalized.
Yeah, that's a good point. I'm saying all the time, just look at what FDA has done with hemp. We got a ways to go.
Be careful what you wish for.
Yeah.
Correct. I mean, we would look at certain parts of the value chain there, but it's a challenge space generally.
Yeah,
So-
it hasn't been doing too hot, to say the least.
Yeah, exactly.
All right, anyone else? All right, well, thank you
you.
all very much.
Thank you.
Thank you.
Thank you.